afternoon, folks. It's Dave Burrows, Chief Strategist at Barometer Capital Management. I want to thank everybody for joining us today. What I thought I'd do is take a quick rundown from the top, looking at what's been happening from a macro perspective this week. It's been an interesting week. US dollar has been weakening. There is lots of discussion about the role of the dollar in the world. There's been lots of discussion around economic activity, and let's take a look underneath the covers and see what's been going on. Now, keep in mind, we aren't trying to be everywhere. Barometer, it's all about being tactical, about picking our spots. I think that our job as managers is to try to identify pockets of the market that may be under-owned, where we can see money is being put to work, where we could see the likelihood of a structural revaluation or multiple expansion. There are always parts of the market perhaps we should be avoiding. There are always parts of the market, where there is opportunities, and our job is to pick our spots. So our job is to find market leadership, and that could be sectors or themes or asset classes that have a tailwind, that are seeing money get put to work, where we see breadth expanding or greater participation. And leadership can take many different forms. It can be specific styles of companies. It could be specific geographic regions. And ultimately, sometimes leadership can be very persistent, can go on for a long time. What starts as looking to be inexpensive, can get expensive, and then can get more expensive. So we have tools that we try to use to identify structural change, and we're always looking for signs of new leadership, areas that we can expand the portfolios to get greater diversification. And we also recognize there's going to be times when nothing's working, and in that case, maybe we need to sit on our hands, have the ability to hold a larger cash weight, or avoid big parts of the market. So we really do take a tactical approach to things. It's very hands-on. We're reevaluating every position we own every day based on our very specific set of tools. And I look through those lenses weekly to try to make sure we're being transparent, to highlight what we see changing, and therefore what we're doing in the portfolios to address that. Now, just from a big picture perspective, we believe we entered a structural bull market in stocks in 2013, and that has been ongoing since. We've remained above this rising 200-week moving average, which tends to be a lower bound in a long-term bull market, much like it was all the way through the 80s and 90s. It doesn't mean that you don't have significant corrections, and in some cases, bear markets along the way, recessions. But when structural revaluation begins, or a secular bull market begins, it can go on for a long time. 80s and 90s was 217 months. Market was up 1,300% by the time it was done. And while we have been rallying for about half that length of time, the market's only up a couple of 100% off those lows, partly because we've been through a bear market over the last 15 months. But in our opinion, we continue to trade above this rising 200-week moving average. The market likely has discounted what would be a typical recession. And at this point, there is no sign that we are headed into the thing that everyone's afraid of, which is a structural bear market, where not only do you break those lows, but you go substantially lower. To get from down 25 to down 50 takes some kind of a crisis, something that is more structural in nature, something that causes major credit risk. And at this point, not to say it can't turn into it, there is no sign of that. But we'll push on that as we go through. We think from a big picture perspective, we saw generational low in interest rates in 2020. And we know that they were falling for 40 years in fits and starts leading up to that point. So you can imagine that things that benefit from falling interest rates probably did pretty well during that 40 years. And that is the truth. It is unlikely, if we're into a world of rising rates and fits and starts, that those same things are the beneficiary of the backdrop of the economy and the market. So again, we try to keep our eyes open to a changed condition. be willing to look at the possibility that what has worked over the past may not be what works in the future, and to look at what happens during those previous periods as guideposts to be what to be watching for. We know that the 10-year yield dropped from 1981 through 2020, where then it rallied sharply from 40 basis points in the 10-year bond. And over the last number of months, we've been consolidating in a range between about 3.5% on the low end and 4.25 on the high end. We know last year was a terrible year for bond investors, and it's not been that much better this year, but certainly bonds have bounced a little. This is the ETF that holds 20+ year duration treasury bonds. And you can see we've rallied up underneath this declining moving average, but the moving averages are still declining, even the very long-term moving averages. And at this point, there is no sign that bonds are about to rally sharply or give great returns as they have during a period of falling rates. We know that when we compare the SPDR, the S&P 500 ETF, to the TLH, which is the long bond ETF, the SPDR, or the S&P 500, has consistently outperformed since 2013. And even through a bear market last year, S&P has continued to outperform the bond market. So we prefer equities over bonds. When we look at other asset classes like commodities, we also believe there's been structural change. We went from a bear market where commodity prices, as measured by the DBC ETF, which is a broad-based commodity ETF, fell from 2008 through 2020, rallied sharply through 2020, 21, and into 22. In fact, commodity prices continued to push higher for the first 4 months of 22, while the S&P was selling off. It eventually settled into a consolidation and has consolidated for many months. Over the last few weeks, we've been saying we're coming to the point where we're going to go one way or the other. And this week, the DBC index broke above that pennant. So our comment was we are likely to see a continuation in the rally in commodities. I can see here we got a spelling mistake on our screen. But the net of it is that that's probably pretty important. This is Brent oil breaking above the range. No, it's not. It's the commodities index breaking above the range. This slide clearly needs some work. But on the back of strong oil, DBC moved higher. Also on the back of gold. The gold monthly chart broke out of this large cup and handle range. We talked about this at the end of last month. Following through here, we're well through $2,000, which probably means we're on our way to 2,500. Silver through 2,450, probably on its way to $28. These are important assets because they're assets priced in US dollars. They have been rallying in other currencies until recently. And now with the US dollar starting to weaken, showing up in US dollar pricing. This is the silver monthly chart. Again, broke out of a consolidation, pulled back over a period of months, and now breaking above the range. So these are pretty substantial changes. We talked about this a few weeks ago, gold versus the S&P 500. Gold outperformed the S&P 500 from 2001 through 2012, underperformed from 2012 through 2022, and recently started to outperform and broke this downtrend. So these, again, are changes that we have to sit up and take notice of. Now, one of the discussions is that there's a bloc, China, Russia, Iran, Brazil, and others, who have talked about and are considering settling import-export trades in yuan instead of US dollars. Could it be that there could be a challenger to the US dollar? Well, there are some countries starting to hold other currencies as reserve. If we look at the Goldman Sachs Commodities Index versus the S&P, it's been getting very close to reversing out of that pennant. Again, this would take the whole commodities complex and set it in motion versus the S&P. The DBC Commodities Index versus the bond market, outperforming over the last 2 years, consolidating over a period of months. Again, this will be a question to see if it breaks out as well. So commodities as an asset class are a real alternative to equities and are a real alternative to fixed income and should be considered as part of the alternative portion of a portfolio. We know that when commodities start to outperform, as they did back in 2000, the outperformance versus equities can go on for a long time. And we've only just begun this. So US dollar last week, we looked at the fact that it, through the course of the bear market in US stocks, rallied as a safe haven. It also rallied because of rising interest rates versus other currencies. And then around the time the US stock market bottomed in October, US dollar started to back off and backed off all the way through until February. Broke trend, it broke all of the moving averages. And then we bounced through the month of February when stocks retraced some of their gains from up to December. US dollar rallied. US dollar started to back off when it hit resistance. In other words, the rally attempt failed. And this week followed through lower. Today, we closed the lowest low since we've seen since the end of February. And I would say there is a real chance that we break these lows and head lower. That's what it looks like commodities are telling us. So this week, we know we had some news on oil. We know the Saudis decided to cut, the Russians decided to cut roughly 2 million barrels a day, all in, to be cut over the next month and through until year end. That certainly buoyed energy prices, but the US dollar weakening may be telling us something. Now, if just from a process perspective, we come at this a couple of different ways. My focus is top down. I'm trying to identify the investable areas within our mandates that we should put money to work in. So there's a lot of different areas we're trying to find pockets of the market that are seeing net new inflows. Where is money getting put to work? Where would the money coming in behind us? Those are our macro themes, our leadership themes. We have a research team that takes 60,000 securities and looks for a combination of about 20 factors in the income statement and the balance sheet. And from a price perspective, that identifies securities as leaders within their sectors or themes. This is bottom-up fundamental work. And where we can find securities that meet our business tests in areas of the market that are seeing net new inflows of capital, that's where our portfolio should live. Now that's a living, breathing thing. It's a dynamic list. We need 20 to 30 names in a portfolio. There's 60,000 to choose from. We got a lot of choices. So the very important tool that has to go along with that is a very disciplined selling strategy, a series of stop losses. We identify a price below the price we enter at, where if we're wrong and the security drops and hits that price, we've used up our risk budget, we're going to go to the sidelines. It means sometimes we get shaken out of positions and they turn around and take off. That's okay. That's the cost of insurance. As positions work out as we hope or expect, we'll ratchet stop losses up and behind, which means that we can stay in the positions that work as long as they work. And sometimes that's for years. Sometimes it's for a shorter period. But it makes sure that little mistakes don't turn into big ones. So from a breadth perspective, we're always looking for areas of the market that have become very narrow, where very few securities are doing well. And when we see the leaders start to perform well and it broaden out into more and more securities, that's healthy. That's money getting put to work. So we measure breadth across about 300 universes of securities. There's no bear market that ever took place in any corner of the market while breadth was expanding. That's a constructive characteristic. Now, it doesn't mean that stocks can't keep going up when breadth starts deteriorating, but it means the ice is getting thinner under your feet. It means the risks are being elevated. It means it's easier for something to break down. So when we see deterioration in breadth, we'll raise a little cash, we'll tighten up our stop losses, and we stop putting any new money to work in a neighborhood that's showing deteriorating breadth. So why is this relevant? It's how we manage risk. Right? When breadth starts to deteriorate, we're going to always get a little bit more cautious, and our portfolios will reflect that. Now, during the financial crisis, going back into the 2008-2009 period, while the index continued to strengthen through June and July and into the beginning of August in 2008, breadth had started to deteriorate. Now, I put this up because I hear lots of people comparing the weakness that we're seeing right now in banks to what happened in 2008. And I have to say, market is behaving completely differently. In the early part of the financial crisis, the index did fine, but breadth was deteriorating. So when the breadth model turned down in June of 2008, we started to raise cash. And by the end of July, we had about 26% cash. By the time we got through to the end of August, we were 34% cash. Market was just starting to weaken, but breadth had been deteriorating for 6 months. By September, we had about 40% cash. Now the market was in free fall. Now, of course, the market went on to be weak for many, many months following that. But having that cash position helped us. The reason we had the cash position was because the breadth models continued to weaken. It wasn't an opinion. But what it did do was insulate us in all of our various mandates against that decline. Now, in 2020, we went through a very sharp sell-off. And during that period, breadth models turned down, we got defensive, and were able to defend well on the way down. In fact, it's worked well through a lot of declining markets. If we look at the S&P today, we've highlighted that in October, we saw a low, we saw a higher low in December, and we saw a higher low in March. If we look at the percent of stocks in uptrends, it's been improving since October. Last week, we highlighted that while our breadth models were weak for the NYSE and for global stocks and for Canadian stocks, our short-term indicators had started to turn higher. Fast forward to this week, the short-term indicators continued to strengthen. They're not weakening, they're strengthening. Percent of stocks in uptrends in the US market moved up sharply over the course of the last week. So we have improving breadth in the internals of the market, not deteriorating breadth. So instead of raising cash, we are actually putting cash to work. Let's talk leadership for a second. Now, normally I go through a bunch of our leadership themes, but I want to focus on some of the things we've seen changing for the better. In October, when we take all of the sectors that we follow in the US market and put them on a distribution curve, with the sectors on the far left having the weakest breadth or the smallest percent of stocks in uptrends, and the ones with the highest percent of uptrends being at the right-hand side, you can see everything was stacked on the left. The picture between then and now looks quite different. Breadth has been moving to the right. Sectors in general have been improving. Sectors in capital letters are showing expanding breadth. So let's talk about that. We have expanding breadth in industrials, including aerospace, steel, machinery. Basic materials, we have chemicals, precious metals, steel also improving. We have in technology, software and electronics showing good improvement. We have improvement in some areas of consumer discretionary, including auto and leisure. In financials, we see improvement in insurance and Wall Street. Now, you'll note that banks and savings and loans, or regional banks, are at the far left side. They are under some pressure. You'll note that real estate, investment trusts, and healthcare under pressure, telecom under pressure. So there's have and have nots. But largely from where we were in October to where we are today, things continue to heal. We've talked about the fact that bottoming is a process. And markets don't bottom when the economy goes through the bottom of a recession. They discount things previously. The fact that the S&P at the worst point last year was down 27.5% is very typical of where a market would be discounting a recession. It may well be we're in a recession now. There's weak PMI data this week. I get it. But the market's a forward-looking mechanism. And we see clear improvement in breadth on the market internals. The market is broadening. That's healthy. So when we look at our holdings, a couple things that changed. One, we've taken down our short-term bond weight. As we said, this was short-term bonds being held to be used as a source of cash. We have seen some new strength in technology, specifically in semiconductors and software, but the very largest of large cap dividend payers. And that still isn't underweight, but we've taken that up over the last month. We've taken our energy weight up over the last month, and we've taken our materials weight up over the last month. Let's talk about that a little bit. This is the XLK, which is an ETF that holds large cap tech. Names in this list that we own. We own Microsoft, we own Apple, we own NVIDIA, we own Broadcom, and we own Oracle. It's not in this list. So we own the largest of large caps. This is relative strength versus the S&P, which has been sharply improving since the middle of December. Early in the year, we said the market has to prove it to us for us to get interested in tech again. We started with a small weight, which is what we always do. We've seen improvement in breadth, so we add bits and pieces. And here we are 3 months later, we have about a 17% weight in large cap tech. The common characteristic is that they are dividend growers that we own and companies that are generating lots of cash. Let's move away from tech for a second. What happened this week in oil? Well, after consolidating for a long period of time, we know that oil broke out in 2021 and 22. And then we consolidated, and the companies pulled back with it. We got a short-term breakdown that turned out to be false. We got the news out of the OPEC countries this week and have now broken above this range. So now from a price perspective, oil prices seem to be making a turn. And while we don't have as much energy as we had early in the year, we do have significant weight in long life assets, companies like Canadian Natural Resources, Athabasca, Meg Energy, staying mostly in energy, a little bit away from natural gas. But I think the big story this week is what's happening in the precious metals. This is a group that's been under-owned for a long time. We are not gold bugs, and I've made that point on a number of occasions. But this is a very significant technical price pattern called a cup and handle. And it's a particularly long one, going all the way back to 2011. This is probably one of the most prolific technical price patterns that I can point to. And the fact that over the last 2 or 3 weeks, we've started to come out of that consolidation means it's highly likely gold prices are going to be on the rise, as are silver, as is platinum. And the producers likely to benefit. The reason we own producers sometimes is because if you own the right ones, they have significant assets in the ground. So yes, they have their production, but if they have a long life asset in the ground, that gets revalued as the price of gold goes higher. It's likely based on this price pattern that gold is on its way to $2,400, $2,500 as a first stop. Silver trading through 24.5 today, on the way through 25, likely on its way to 28. We saw the gold miners ETF today, GDX, break out of a multi-month range. That's a positive. But when we look at individual securities, we're seeing something much better. Wheaton Precious Metals would be the number 8 position in our top 10 holdings across portfolios at Barometer. It's a company that owns a broad base of 23 operating mines, 13 development projects, and generates a stream of revenue from most of them. It's moved sharply higher over the course of the last few months. In September, it was trading at $30, it's trading at $50 today, making a multi-month new high. And this is a large cap company. It's a $22 billion market cap, pays a 1.2% dividend, but it's grown its dividend 14% a year over the last 5 years. You don't think often of dividend stocks being gold stocks, but Franco-Nevada is another that we own, another significant holding. From a growth perspective, Alamos Gold is a Americas-based gold producer. It's a $5 billion company. They've got properties in South America, Mexico, and Canada. And again, has broken out now to a multi-year high. In fact, if we look back you can see we've made a 5-year high. So when a company makes a new 5-year high against a group that's just really started to rally, something to keep in mind: Alamos Gold, an interesting holding, and Torex Gold in the smaller caps, a $2 billion company. Again, more holdings in Mexico. It's been trading much better than the market. You can see the relative strength versus the S&P has been rallying sharply since September, and is very close to making relative strength new highs. So some shifts that are taking place that I think are important and we have to recognize. We've talked over the last few weeks about the fact that global stocks, for the first time in many years, are outperforming US stocks, and that continued this week. Europe marching on to make new 52-week highs. A bunch of countries showing strength: Germany, France, Italy, Spain, largely to do with the makeup of those indices. Mexico trading at new highs, and the Japanese ETF EWJ, strong relative strength since the month of October. So we have our baseline positions that are North American oriented. We have alternative products that we hold largely within our macro portfolio. Another macro alternative are the cryptocurrencies, which again, over the last number of months have started to show some improvement. And it's something else that we take a look at in our macro portfolio from a long-term perspective. Again, assets that are doing better as the US dollar is weakening. So macro is an alternative fund. It's something that is held as a complement to some of our other holdings. Looks very different than other portfolios. Right now made up of precious metals, commodities, some cryptocurrency, and some global equities. We continue to be short fixed income. We're short regional banks, and we're short real estate. So just to kind of wrap up, I continue to hear the concerns around recession, but there's still a lot of liquidity. Volatility is nowhere near where we were when markets were in difficulty. Our breadth-based models continue to show improvement. Credit spreads are not showing distress in credit markets, and the market continues to consolidate above a rising 200-week moving average. There's been a lot of bad news. There's been a lot of reasons for the market to sell off. But for whatever reason, whether it's concerns about inflation and wanting to own assets that can offset inflation, or whether it is that there's just so much liquidity in the market that it has to find a home to get a return, equities continue to have a pretty strong bid. And that's despite the fact that we know that there's more cash sitting in money market funds than at any time in the last 15 years. So I put this stat up last week. We're through the first quarter. And in years where you had a low at the end of the year, and the first quarter low was above the low from the December low. If you go all the way back to 1950, this is what happened for the full year returns. An average of 18%, or a median of 18%, and positive 94% of the time. So we continue to watch for signs that things are getting worse. We watch our breadth-based models every day. If things start to change for the worst, we'll get more defensive. But again, bottoming the process. And what we've been through is a correction or bear market that would be typical of a recession. And the market looks out 8 to 12 months ahead to see where things may be by then. So let's have some patience. If things get worse, we'll get more defensive. But at this point, we think there's some real opportunity, and we think that we are into a period of 18 to 24 months of some pretty strong gains. And we're just going to have to sit through the news flow and try to let the market do its work. So with that, I'm going to check and see if we got any questions. I don't have Pamela on the line today, so I'm not quite as good at this. One question: have we ever written a book about the market? Well, there's one in the works. Books that I think that I would recommend reading. There's an excellent book by Tom Dorsey called Point and Figure Charting. That's an excellent book. I'd buy the book How to Make Money in Stocks by William O'Neill. Another excellent book. Those would be two that I can recommend. The Dorsey book is good at helping to understand the internals of the market. and look at things clinically. And the How to Make Money in Stocks is a great book talking about the characteristics of great companies and what to look for when you're picking individual stocks. And then the last question I have here is on uranium. And uranium is improving. It showed some improvement over the course of the week. Had a tough day today. A bunch of economically sensitive companies sold off today internally in the market. The Russell 2000 was down 1.7%. S&P was only down 50 basis points. I think that the uranium chart is shaping up. We have a small weight, about 1.5% in our macro fund. We'll add to it if it starts to firm up. And I think that that's it. Okay, well, thanks everybody for joining us. Send us questions directly if you'd like us to answer them. You're too shy to ask them during the webcast. We do this every Tuesday at 4 o'clock, and hopefully you find them useful. Thanks so much.